My assets good evening. This time we are going to have an interview with Aashish P. Somaiyaa. He is a Chief Executive Officer, White Oak Capital. Good evening, Aashish Somaiyaa. Welcome to our channel, myassetsconsolidation.com. Currently, we are the last 5-6 months, we are slightly very active on this. The last 8 months time, we had close to around 10,800 subscribers we have reached on. And the last 3 months, our subscriber base has increased by more than 6,000 without any marketing support. It's purely only on the quality of video we have enhanced it. We never used an external. Even the videos we are till recently we are doing everything in-house, right from editing, everything we have done it. We are happy to welcome you to our channel. For viewers, I just want to introduce who is Aashish Somaiyaa. Aashish Somaiyaa is CEO of White Oak Capital Management. White Oak, Aashish comes with a background of typical engineering plus finance. That is a trademark of the mutual fund industry. You know that a lot of CEOs and CEOs have engineering background with the finance. Incidentally, I also come from engineering and CFP. That was my combination also. And Aashish has passed out in engineering from Pune University. And he's passed out his master's in finance from NIMS, Mumbai. So Aashish's role currently is that strategizing, growing, managing the operations of White Oak Capital, a highly differentiated equity-oriented boutique managing firm, offshore funds investing in India, as well as the AF and PMF strategy. The White Oak Capital has been founded by Mr. Prashant Kenka, former CEO of Goldman Sachs. So that tells you about his background. I don't need to tell you more about him. So currently they are managing quite a good wealth, and they are very recently moved out to mutual fund also in 6 to 8 months back. They are in their basket. They have a couple of funds that have already been floated, and it is collected a very good amount during their NFOs. Prior joining to White Oak, Aashish was part with Motilal Oswal. You know that Motilal Oswal is a brand where it's for any research reports you can trust on Motilal Oswal. So Aashish was heading the Motilal Oswal AMC division, was a MD and CEO for 8 years. So he has differentiated the boutique managers backed by the excellent track record. When Aashish was starting in 2013, they are around 1,300 crore was their asset size. When he moved out, it was currently it's 42,000 crore. So that's a incremental size. He has helped Motilal to grow. And you know that in 2018, Motilal has got a leadership award by CNBC for their performance. And before joining Motilal, he had a long stint with ICICI. In ICICI, he was heading sales and distribution for that. During that period of time, apart from mutual fund, he was also managing PMS and real estate under his sales marketing basket. And across this distributed across India and Middle East also. He has been one of the instrumental in developing a new product for Motilal. So that means he has a good at communication, distribution. So whatever a salesperson should know, everything is knows apart from his technical qualifications. I think he's the right person to speak about this current market situations. And everybody, right from individual to want to either astrology, they want to know what is an outlook for my 2003. And similarly, I also been a lot of people are eager. They want to know at Diwali what will happen for next 1 year. So normally I don't believe about Diwali of New Year, and because the investment is a long-term journey, doesn't comes with a basket of 3 months, 6 months, 1 year. Then if your basket is 3 to 6 months, 1 year, better you are not supposed to get into equity market. But still, as an investor, you are always think what is an outlook for me. I now open the floor and request Aashish Somaiyaa to share his views on what is an outlook for 2023 and where my investors has to put money onto that. Please, Aashish.
Sure. Thank you, sir. Thank you for inviting me today. Many compliments on your, the efforts that you are doing to communicate with your investors and also, educate and answer their queries and their concerns. Now, on 2023, I think that it's good to start with a background of what has happened in 2022, because then that will lay the context of what one can really expect going forward. So if you see, 2022 has been a challenging year. We started the year with Nifty at about 17,400. And, the worst point we went to 15,200. That's like, nearly 15-20% kind of correction at the lowest point. Because the high of Nifty was 18,500. That was in October 2021. In January, we were at about, 18,000, well below 18,000. Lowest point we went to 15,200. And then, just a month back, we were 18,900. People were saying we will cross 19, we will cross 20, etc., etc. But the way December is going, we have again started to correct. So I think a year full of volatility. Ultimately, we are ending close to where we started. A lot of ups and downs, but hardly any return being made. The second thing of 2022, what I've seen, most common question is that when I meet investors, that, the index is going up, but our portfolios, index is making new highs, has made new highs this year, but portfolios have not really made new highs. So I think 2022 in that sense was a challenging year because a lot of volatility, ultimately not much return. And second is optically, you can see that Nifty went up, but not many portfolios went up. I think that was because of the war. If you this year, what has happened is that while Nifty has gone up because of few stocks, if you see Nifty 500, if you see small cap index, if you see mid
Ashish,
cap
sorry
index,
to interrupt you. Slightly, voice is slightly to be increased.
sure, sure.
Yeah, please.
So what I was saying was that Nifty, if you see Nifty 50 might have made new highs, but if you look at Nifty small cap, Nifty mid cap, Nifty 500 itself, I think they are below their previous high levels. So I think it's been a challenging year. Also, because of the war, what happened was quite unexpectedly oil, metal, commodities, sectors which are heavily dependent on macro or global factors, sectors which don't actually come up in bottom-up research or sectors which are not widely held in people's portfolios. Because of the war, I think some of these speculative sectors they went up, and generally the ones which generate consistent growth, like whether it is IT, pharma, chemicals, private sector banks, a lot of these sectors either didn't perform much or they were actually laggards. And in 2022, why did we witness all this volatility? We witnessed volatility purely because of the economic situation in US, the war in Ukraine. Because of the war in Ukraine, you know that Europe is like a slightly collateral damage. And you also hear variety of news about China. So you have multitude of reasons why the market was volatile. Unfortunately, when we are exiting 2022, none of those reasons have got resolved, and still they are lingering. So that's a backdrop for forming a view for 2023. My sense is that the first 3 to 6 months of 2023, whether it is US economy, whether it is the war in Ukraine, whether it is the COVID situation, I think some of these issues will come to a head. The market will have to digest some of these issues. Beginning of 2023, you will still have the kind of volatility that you have seen in 2022. But I think that first half of 2023, if you let the volatility pass, if you actually invest when there is any downside in the market, then I think the second half of 2023 is going to be much better than what we have seen in 2022 or even in first half of 2023, what we are going to witness. So my sense is early part of 2023, we will still be seeing continuously what we have seen in 2022. Somewhere in the first half of this year, I hope some of these issues get precipitated and resolved. And my sense is the second half of 2023 will be much better than what we have seen in recent times.
Yeah, now as an investor, now I'm slightly confused, because a lot
Hmm.
of media inputs are coming. Now the social media is playing a major role. Some of the people are telling take the money out and stay with the liquid, and some people are telling that stay invested. As an investor, my goal is 5 to 10 years away from now. Do you need to
Yeah.
book a profit? I can stay invested now.
Sir, see, I think there is a couple of learnings, and for this, I would like to give you examples. First of all, is that, a lot of times people give these warnings in hindsight. But let me give you an example. Let us say in 2020, we had this whole COVID related issue. And you know that in March 2020, stock market declined by 30-40%, right? That was a very scary or a disastrous situation. Now, let me give an example. Let us say in February, you mentioned astrologers and all. Let's say in February 2020, some astrologer came to you and said, Sir, there is going to be a global pandemic. People will be locked inside their homes. Nobody can move out, and stock market is going to collapse. Let us say somebody gave you warning in February 2020. What would you do? You would remove all your equity and you would hold it with you. And in March 2020, you would be very happy that, oh, great astrologer, look, he has given me fantastic prediction. You would be happy for 2, 3 months. But by the time October, November 2020 comes, 6, 7 months later, the market was making new highs. So what it means that the guy who told you in February 2020 that please remove your money, you expect that same guy to also tell you in March 2020 that, sir, please come back, right? Now, that's the whole point that this COVID pandemic, war in Ukraine, again, a lockdown in China. See, these are macro events. All these macro events cannot be forecasted. And what is even more challenging, even if you forecast the macro events, you will not be able to forecast how the market will react to those macro events. I'll give you another example. In July 2021, if somebody came and told you that, look, in the next 6 months, there will be a war, oil will go to $125 and rupee will crash to 81, and FIIs will sell 30-40 billion dollars of Indian equity. Again, you would have taken your money and run away. But this year, what has happened? We didn't make much return, but it's not like that the market has crashed because of all these things. So what happens is, again, there are many examples to show that you cannot predict macros. And even if you are an astrologer who has predicted the macros, you will not be able to predict how market is going to react to those macros. So best is not to listen to any speculative advice. Second important thing is, what should you do as an investor today? I think that if you have money to invest, don't go all in at once. Basically, what you do, my sense is that next 3 to 6 months will continue like how last 3 to 6 months has been, full of ups and downs. So I would put it this way: you park your money in a ultra short term fund. It is giving 6% right now. Park your money in a ultra short term fund and put a systematic transfer over the next 6 months into equity. Over the next 6 months, also, how you divide it into fortnightly. So 6 months, 12 fortnights. If you have 100 rupees, 8 rupees per month, you divide it over the next 8 rupees per fortnight, divide it over the next 6 months. I think somewhere you will overcome all this volatility and turbulence. Probably you will get a very, very good average price if there is any up or down. And I think that 12 to 18 months, I'm not even talking 5, 10 years. I know everybody has 5, 10 years time horizon. But if you live through this period and if you stagger your investment over the next 6 months, I think in a year, couple of years, you are bound to make above average performance.
Yes, now you said that you have to put it in ultra short term and try to do STP. I'm an investor
Yes.
now. Would I have to invest in large cap or invest in mid cap or small cap? Where I need to park my money?
So I think that in a market like India, the best place, if you really ask me, if you're a risk averse investor, if you don't want to expose yourself to any one narrow segment of the market, then I think funds which put half the money in large cap and the other half in small and mid cap. Some people have flexi cap funds, some people have multi cap fund. In our case, we call it flexi cap. I think that is the category to really invest in. But if you really ask me, if I'm not conservative guy, if I'm looking to maximize my return, and if you ask me my personal opinion, what is my favorite? I would say the best segment of the market is mid cap, not large cap, not small cap. The best segment of the market is mid cap. The reason is two or three things. One is, today, if you see, there is a lot of talk that in India, the per capita income is set to rise. And India is moving from lower middle class to a middle class kind of country. We are $2,400 per capita income. We are expected to go to $5,000-6,000 per capita income in the near future, foreseeable future. Now, when people become from lower middle class, when people become middle class as a country, I'm not talking about you, me, or our listeners, as a country, as a whole population, when we move from lower income to middle income, the first priority of people is to look better and to live better. That is the reason why apparels, retailing, eating out, beauty products, footwear, I think these are the kind of things, all of these sectors, all of them are part of the mid cap segment of the market. So I think second important tailwind I can tell you, that in India, a lot of manufacturing activity is picking up. The government is incentivizing by way of production linked incentives. Look at it closely. Where is the production linked incentive of the government? It is for textiles, auto ancillaries, EV components, chemicals, pharmaceutical APIs. The whole everything you look at, all those sectors have a preponderance of the mid cap market cap, right? So I would say that, and even if you don't look at my forward prognosis, you look at last 10 to 15 years also, what you will find is that the best performing component of the stock market is mid cap. The mid cap index has done better than large cap, small cap, and even Nifty 500. So I think that the best segment to do STP, SIP, whichever way you do, the best segment is mid cap. But if you're a risk averse person, don't want to stick to any one segment, then I would say multi cap, flexi cap is the second choice.
Yeah, now having you said that, now you mentioned about a few of the sector like pharmaceutical, auto, banking, or something like. So assume I want to take extra risk, want to get into some sector based fund. Would you suggest me to take a auto related sectors to invest in the markets, or I can go with the banking and financial like that? Because we have a lot of different products available in the mutual fund. Which sector you
Hmm.
suggest me at this point in time for investors to get in? I want to take 5 to 10% of my exposure into the specific sector funds. Which sector you think it's a better bet for this point in time?
So I would say, see, first of all, needless to say, we expect that everybody who's listening to this conversation would have the understanding and maturity to know that exposing yourself in any one sector can definitely be high risk, high return strategy. You have also qualified that okay, if there is somebody who's willing to take extra risk, and apart from the diversified exposure into any mid cap, flexi cap, let's say they want to do overweight or they want to put extra weightage into some sector. So with all those caveats in place, I would say that there are two places. One is financial services. So let me clarify. Generally, the sector which people follow is when somebody says a Nifty bank, people follow the banking index. But I hope you have noticed that you and our listeners, I hope they have noticed that nowadays, other than Nifty bank, there is another index which is Nifty financial services, which is basically not just banks, but it also has insurance companies, asset management companies, wealth management companies, exchanges, registrar and transfer agents, broking companies. So I think the broader universe of financial services, which is not just limited to banks. So I think that is one index or one segment to look at. The second one I mentioned in my conversation, which is related to consumer discretionary. By consumer discretionary, what do we mean? We don't mean soap, shampoo, and food. That is consumer staples. When we say consumer discretionary, that's the other one which I mentioned, which is everything to do with retailing, apparels, footwear, beauty products, all of those things. So I would white goods also, electronics, white goods. So I would say that the financial services, which is the broader definition of financial services beyond just banks, and the second is consumer discretionary. I think these are two which one can put money and forget for 5, 10 years. And my sense is that given where our economic develop stage of economic development is, these would do quite well.
It's a maybe a personal question. Now, on your portfolio, all these years you are managing it. How much percentage should have allocated your portfolio to equity as asset class and debt as an asset class and gold as an asset class? And if it in equity, what percentage of that could be exposed to mid and small cap?
Sir, so see, clearly I am not a good example to take, but since you are asking me, I will definitely answer for myself. I am fully exposed only to equity. There is some amount of real estate, but for me, real estate is also linked to economy and linked to equity. So I have no debt in my portfolio. I don't think that is the right way for generally for all investors. See, because I have been in the stock market or associated with the stock market directly, indirectly for 24 years. And on a lighter note, I always say that in my 24 years, at least 4 times I have been told that the world will come to an end. But I don't lose sleep even if somebody tells me world will come to an end because I am very comfortable with. See, I'll give you an example. Let us say that we go to a very, very tall building, skyscraper, right, sir? When we go to a skyscraper, let's say we are on the 40th floor of the building and we want to come to the ground floor. When you get into the elevator, how do you know that the elevator will come down from 40th floor to ground floor? How do you know it will come down at a calibrated speed? It can just drop down, right? So how do we trust that it will come down at a calibrated speed? We trust it because we have been told that the lift is manufactured by Mitsubishi from Japan. There is some braking system. There are some safety cords. There is a hydraulic system which is ensuring that the lift has, some mechanism. Now, we are just trusting it. We have not seen the braking system. We have not seen any safety cable. We have not seen any hydraulic system. We are just thinking that, yeah, it's a lift. This is how it is supposed to go down. When you see the stock market, most people, every time the stock market falls, most people think that world will come to an end, money will become half, and we should not be in this place. This is just not for me. They get scared. For me, when stock market comes down, I have as much confidence as I have when I go into a elevator, because I know that when stock market is coming down, when stock prices are falling, I know that ultimately there is a limit to how much it can fall, because the companies have earnings, right? And if companies, as long as companies have earnings, as long as we have an economy, prices cannot fall beyond the point. And if prices fall a lot, it is only making it more and more attractive. It means in future we are going to make above average returns. So my level of comfort with stock market is much higher than what I can imagine for most of the people. So I am comfortable being 100% in equity. And even if equity falls 20-30%, I don't lose sleep. But most people would not be comfortable with that. So that is why, I gave long explanation. I am fully invested in equity, but not why I gave the explanation, because it may not suit everybody. So I would put it this way, that, for vast majority of the people, they have to go to an advisor like you and describe their personal circumstances and their personal, risk appetite as well as return expectation. And then they have to make a proper asset allocation. So I think for most investors, having mix of equity, debt and gold, and if they can manage maybe real estate, I think for most people, a mix is advisable. They must definitely consult an advisor like you and get it planned out properly. Sorry for long answer, but since it was asked me, I am fully into equity.
Yeah, because why I ask that question? The people are in the industry, they are investing, so that gives a confidence for the people who are coming up. You don't need to put 100 rupees, you put at least 10 rupees of our 100 rupees. You can build over a period of time. We also have, the market has gives a lot of opportunity for, you can do a step up SIP, variable SIP or STP. All that facilities are available for us. What I feel that
Yes.
investors are not taking the variable SIP, they are not taking the STP, step up STP, they are not taking. But end of the day, they say that we are not making money. And also, I noticed one more point, Ashish. I thought I can draw your point also. The new investors, every day I get minimum 2 3 calls I get that, sir, I'm a new investor. Shall I invest in index fund or shall I invest in a diversified fund? I asked, what is the reason you want to index? I see in social media they are only suggesting index fund, not invest in diverse fund. What is your take on that in a country like India, where its growth potentials are very higher? The transparency levels of the companies are not that good when compared to their developed economy. What is your view on index funds versus the diversified fund?
No, sir, I would just put it as one simple statement, and I hope that it is not very complex, or it's easy to understand. See, it's like this. When you invest in an index fund, a lot of the thinking comes from America, right? Now, what happens is that it's a very, very advanced, very, very developed market, and almost good part of their economy is already listed in the market. So how can you outperform the market? There are very few avenues to outperform the market, because the entire economy is listed in the market. So let's put it this way. In India, a bulk of the economy, footwear companies are coming for listing now. The first insurance company got listed 3-4 years back. Now, all this has happened in America 30-40 years back, right? So what I meant that, just what people should understand, do not worry about index capturing the market before the market captures the economy. In India, bulk of our economy is not even reflected in our stock market. So where is the question of the index capturing the entire market? So I think that is one thing to really, really keep in mind. The second thing to keep in mind is that in India also, in last couple of years, it is true that mutual funds have struggled to beat the benchmark. That is not because we have become as efficient or as advanced as American market. That is because our economic performance has been very, very poor, very, very narrow. It's a known fact that when economic performance is very poor and very narrow, so economic performance becomes, that in 2018-19, our GDP growth started declining. By 2019-20, we had 3.5% GDP growth, and 2020-21, we had negative GDP growth. When economic performance becomes very narrow, corporate performance becomes very narrow, and obviously the index performance becomes very narrow. So active managers will find that a lot of companies are either not generating profitability or growing very poorly, or basically underperforming the past expectations, right? So I think that in India, the situation is not comparable to America. Bulk of our market is not even listed. Last couple of years, there has been underperformance because some strategies have not scaled with size, or the economic performance was very, very lackluster. But I don't think that is the situation going to prevail as we go forward. Lastly, what I would say is, I'm also on social media, I interact with a lot of people, but social media is not a place to gain knowledge. Because see, lot of people in India, a lot of youngsters, and a lot of people write on social media. Doesn't mean all of them have 20, 30 years of experience, correct? In fact, if you look at social media as a population or as a sample size, majority of those people would be of a younger age profile. Very few of them would be 20, 25 years in the stock market, and very, very few would be professionals who are writing, correct? So social media is not a place to take advice. It's a good place to bounce off some opinions and some views, but it's not a place to necessarily take advice. So I think that people need to consult, whether it's a registered advisor or somebody who is qualified. I think that is the right one to consult. On social media in 200 characters, uh, people cannot give explanations. So what is driving their conclusions? On what basis they are making certain statements? All that contextualization doesn't happen. So one has to be careful.
Yes, Ash, my last 2 minutes, and I will finish off with that. And viewers also don't want to see beyond 20, 25 minutes. We'll connect with one more, one more point. I want to keep them also happy. See, what I just looking at that the younger investors, they are looking too much into cost, not building a wealth. So cost is very important in creating wealth, but you don't have a good people to guide you on a right period of time. That's a problem. As you said that in February, some astrologer told to take the money out. Somebody should tell you to put the money back. So
Back
unfortunately, people
also.
are looking at one side. Probably they may lose 0.5% or 1% over this index or versus the diversified fund. But over a period of time, a right time advice would definitely help to put, assume you are based on your risk appetite, you are being allowed to only take 12% return. Assume in 2020, for example, somebody by fluke you came to market in March, April, you made 100% return. You can say definitely system allows you to take some money out of that. I'm happy with I made 100% return. I'll take only profit. I can stay invested for next 10 years time. That is allowed. But you are trying to time market now and then try to take the money out. It's not going to help. Those see the close. I know that I have written close to 1,200 articles for Hindu Business Line and 500 articles for vernacular magazines. And I would have done not less than 400, 500 public speaking. Wherever I go, people are too much. Before starting, they are looking at the caste. Where you have to look caste when you develop, grown beyond a point. Then, if you know
Yeah.
you become master of your trade, then you can look at a caste and try to any small business also. They grow, then try to cut the caste to see that it has been there. In an era where startups are burning the money every day and out and see that if you loss is the 5,000 crore, you are king. If your loss is only 10 crore, you are very, very poor people. In a scenario, people are looking at too many tiny costs on that. So this is what my view all about. Thanks, Ashish Somaiyaa, for spending your time with our viewers. We'll catch up with sometime when later, maybe 3 to 6 months time, when Prashant time permits us, we'll definitely invite you. By
Sure.
the time we'll be crossing 20, 25,000 of us viewers. So that point in time, I can invite Prashant to give and speak
Of
to our
course.
investors on that. And nice talking to you, Ashish. Thanks for spending your time. If final words, you want to leave a minute of that for investors, you can leave it.
No, no, no. Thank you. Thank you very much for inviting me. And I wish everybody, all your viewers, a very, very happy 2023. Thank you.
Bye, Ashish. Bye then. Yeah.